So let's talk about common stock. One of the distinguishing characteristics of a corporation is its ability to sell capital stock to investors to raise funds. The amount raised by issuing capital stock is called contributed capital. Contributed capital. Because the funds are contributed by investors in exchange for an ownership claim on the company's assets. The most common type of capital stock is appropriately named common stock. Investors who purchase common stock are called stockholders or shareholders and are the owners of the corporation. So when we look at common stock, and you'll see later on that there's a couple of other types of stocks that we may go ahead and. So when we take a look at stock, there are three things in this pyramid that I want you to take a look at. One is common stock is sold in shares. That is, each unit of stock is called a share of stock. There are three ways in which a company describes its share of stocks. We have authorized shares, which are the number of shares of stock that a company can legally issue. So in your corporate charter, they'll say, hey, we can issue 1 million shares of stock. Then they're going to say, then the number of shares that are issued is the number of shares a company has distributed to owners. So we've issued these shares. And then last is we have outstanding shares, and these are the number of shares that have been issued and are still held by someone other than the issuing company. So we have authorized, we then have issued, and then these are outstanding. These are the shares of stock that are outstanding. Stock has rights, or the owners of the stock, better said, have rights. So when a corporation issues common stock, it usually grants to stockholders or shareholders the following rights. One is the right to vote. Second is the right to participate proportionally in dividends. Second is to participate in the residual assets, and then what we call the right of preemption. And so now we're going to go ahead and take a look. So the right to vote ensures that a stockholder can participate in company governance by voting on issues and actions that require owner consent or approval. An example of such an action is the election of the corporation's board of directors. In fact, that just happened at HP. In fact, we had a couple of board of directors that were ousted. The board, we feel, have made some bad decisions over the last year or two, and so a couple of the board of directors were not reelected and was also encouraged to resign from the board at HP. So next we have the right to participate proportionally in dividends. Ensures that stockholders receive an appropriate amount of dividends declared by the company. For example, if a stockholder owns 25% of the corporation's common stock, then he or she has the right to receive 25% of any dividend the company distributes. So you might be asking yourself now, what is dividends? Dividend is an amount of money that is given to the owners of stock or to the shareholders, kind of like a return on their investment. It's when a corporation typically is doing very well and they want to give a return on the investment back to the shareholders. They don't want to give them back all their money, but they certainly want to keep them interested in owning their stock by giving them a dividend. In fact, it was decided, I heard today, that Apple is going to return $100 billion to its shareholders through dividends. Next is the right to participate proportionally in residual assets. What this does is this ensures that stockholders receive an appropriate amount of assets upon liquidation of the company. For example, if a stockholder owns 10% of a corporation's common stock, when the company ceases operations and liquidates, he or she has the right to receive 10% of all the residual assets. What that means is typically when a corporation will sell everything in liquidation, all they have left is cash. And the shareholder would have the right to 10% of the cash after they sold all their equipment, their buildings, their inventory, and so forth. The next right we have is the right of preemption. This ensures that a shareholder can maintain their ownership percentage when new stock is issued. For example, if a company decides to issue additional shares of common stock, a stockholder who owns 15% of all the shares of common stock has the right to purchase 15% of the new issuance of stock. Because of the record-keeping burden of this right and the ease with which an investor can purchase stock in the marketplace, this right often is withheld from stockholders, and so we don't take a look at it that much today. Okay, this seems sometimes is fascinating to students, and it is something that used to happen a lot. Typically, we may not have par value any longer. However, some states require it. So a corporation normally assigns to its common stock a value known as par value. This par value is an arbitrary value that determines an entity's legal capital. Legal capital is the amount of capital that a state requires a corporation to maintain in order to protect creditor claims. Most companies set par value very low. So if we look here at Walgreens, has set a 0.078125 cent par value for its common stock, while CVS has a 0.01 or 1 cent par value. Although most states still require corporations to set par values for their stock, the value has lost much of its legal significance over time. Because a par value is usually set very low, most common stock is issued for more than par value. So let's go ahead and take a look at what it is, an example that they're talking about. So assuming that a company issues 100 shares of $1 par value stock for $5, the company will record the issuance as follows. We would get $5 times the 100 shares, so this equals 100 shares times the $5, gives us $500. To record it, we are going to put 100 in common stock, always, only, and always and only does the par value go in common stock. So in this case, the par value was $1 times 100. $1 times 100 gives us $100. And the difference between the 5 and the 100 goes into a category that we call additional paid-in capital. So the only amount that can go in common stock on our balance sheet is the par value. Anything above par value goes into additional paid-in capital for our journal entry. Since both common stock and additional paid-in capital are equity accounts, this entry increases the company's asset and equity. So now let's go a look at an example in the textbook. So I am at page 268, and I am looking at exercise number 2. A company issued 200 shares, so it issued 200 shares of $2 par value stock, and it issued those for $10 per share. $10 per share. So right away you know we're going to have additional paid-in capital. So they want us to prepare this journal entry. So what would this journal entry look like at this point? We know that we got cash of $10 per share. So $10 times 200 is, go ahead and do your calculation. So 200, let me get my calculator out here. I feel like Mr. Rogers. You guys probably don't even remember Mr. Rogers in the good old days. So let's go ahead and do 200 times $10 is $2,000. That's how much cash I got, $2,000. I'm going to credit common stock. It's an equity account, therefore it's a credit balance. And I'm going to do that for the $2 times the 200, which gives me 400. And then we call additional paid-in capital. An abbreviation for that is APIC, additional paid-in capital. And that's going to get the difference of $1,600. So this journal entry would be cash for $2,000, common stock for $400, and APIC, additional paid-in capital, for $1,600. The problem goes on to say is what we would do if the par value was $1. So in this case, we would still get cash of $2,000. Common stock would then be $200, and APIC, additional paid-in capital, would be $1,800. So this represents a $2 par value, and this represents a $1 par value. Okay. Let's ask her what happens if there's no par value. What happens if there's no par value? If there's no par value, even though some states do require it, some states don't. So if there is no par value and it's not required by the state, not required, then it would be a debit to cash for $500 and a credit to common stock. If there is no par value and it's not required by the state, we would debit cash for the $500 and credit common stock. You see, we don't have any APIC and we don't have any par value. This is only if we reside in a state or incorporate in a state where they do not require a par value. Now what we want to do is go ahead and take a look at what the reporting looks like. So what we have here is this is our new stockholders' equity section. You'll see that we have something called preferred stock, which we'll talk about. Here's the common stock. So here's the par value for Walgreens. It authorized 3.2 billion shares. It issued, 1 billion in 2010 and 2009. Here's our APIC account. Here's our retained earnings. And you don't have to worry about some of these others. We will go ahead and talk about treasury stock later as well. So this is what a possible stockholders' equity section could look like on your balance sheet. And last but not least, we show you how we would report treasury stock, which we'll talk about later in the chapter. This is the stocks that are issued. Treasury stock is when a corporation buys back its own stock, and we're going to talk about that later. It is deducted from the shares issued, because if the corporation owns it back in its treasury, then they are not outstanding. Okay? Outstanding is what is owned to the shareholders outside of the corporation.